next appointment here. This one actually looks pretty good. Give me a second here, get my AirPods out, and we'll give you the notes on this one. 62, close to retirement, Social Security and Medicare questions, and minimum 100K asset appointment. Not bad. So let's see what we got here. I'm due for a good one.
Sorry, extension number 2141 didn't answer. You've reached the voicemail of. Please leave a message.
Hi, this is Jamie. I'm calling because I had you scheduled for an appointment to talk about your retirement. I'll wait here for a couple of minutes to see if you can give me a call back. If not, we can reschedule. That's totally fine as well. 1746. We'll talk soon. Thanks. Bye. Okay, so what I'm gonna do, it sounded like it was a work email because they said extension. I don't know if she's gonna get notifications for that or not. So what I'm gonna do is send her an email. Say, hi, I had you scheduled for an appointment to talk about your retirement. Is it still a good time? Question mark. Thanks, Jamie. I called, but it went to voicemail. All right, so email sent, and who knows, here it is. I was saying it looked like a good appointment. Again, I preach this, don't judge a book by its cover. It looked really good, and I'm sure it is a good appointment if I can get a hold of the person. Anytime they're close to retirement and they have retirement questions, particularly Social Security and Medicare questions, because that's something that is very hard to find help with, and it's hard to navigate, and it's also hard to coordinate with your employer benefits. So we're gonna give it a minute here. Hopefully they get the message and they give a call back, but a lot of times, they end up getting tied up, they have a meeting run over, and they just aren't able to answer. And so a lot of times they'll get back to you. Fun fact, I can tell you, of all of the advisors on our program, 10% of the time, they don't show up for the appointments. So in other words, they pay for the appointment, they have it on their calendar, and then they don't show up 10% of the time, and that's just the amount of time that we get complaints. We get people saying, hey, I had an advisor who I was supposed to have a meeting and I never got a call, and we're like, oh my God, how did you not get a call from this person? They paid for the appointment. So if 10% of people that pay for the appointments for a lead source don't show up, for obviously probably legitimate reasons most of the time, then what percentage of the time do you think that the people that just have questions about it aren't gonna show up? Oh, here you go. She's calling me back. She must have got my message. That's why we leave messages. Here we go. Hello, this is Jamie.
Hello?
Hi, this is Jamie. How's it going?
Hey, good. How are you? I'm sorry. I don't understand why it went to voicemail. Is this okay for you still?
Yeah, no, it's perfect. It looked like it might have been a work number or something like that because it said something about an extension. And then I left a message, but it's no problem at all. It's just a couple of minutes after here. I'm happy to answer your questions. And it looks like you had some questions maybe about Social Security and you might be close to retirement. How can I help you today?
Yeah, so I just turned 63 and I didn't actually know or fully understand what the session was supposed to be about. I mean, so sorry.
That's all right.
It's more, if I were to retire, what should I be thinking about? I guess maybe because it kind of, I'm 63, as I said. I had originally thought about retiring at 65, obviously, and I just didn't know if I were to think about retiring earlier or later, what sorts of things might I be thinking about?
Yeah, that totally makes sense. Well, there are quite a few things you could be thinking about, but let me ask you a couple of questions just so I have a better idea of your situation, and then we can kind of go from there. Does that sound good?
Of course, yeah.
Okay, so just turned 63. When was your birthday, by the way?
January 9th.
9th, okay. One of my daughters just had a birthday on the 14th.
Yeah, cool.
Very good. So, all right, 63, and then I know you said maybe retiring in a couple of years, but let me ask you, what's your idea about retirement? Like, do you plan on maybe still doing some sort of volunteer work or passion work, or do you plan on, moving down to the beach in Mexico and getting a cabana?
So kind of a combination of the last. So I'd like to spend some time traveling and Obviously not first class kind of thing, but it would be to spend some serious time. My kids are away, so sorry, I'm just having a. We don't have any kids. One is at school, one is working, so we are empty nest, and so we don't necessarily have to think about them. Although my younger son, that's in college, he's a sophomore now, so we are not necessarily ready to up and move anywhere. So it would be that we kind of stay put, kind of get, probably do some volunteer work. We'll find something to do, and travel occasionally. Things like that.
Okay, perfect. Well, that definitely makes sense. And the reason that I ask is because obviously if you are doing some sort of work, then that might produce additional income. So that kind of changes the conversation. But if you plan on traveling a bit and maybe want to keep the door open for different options, that makes sense. And then how many years?
Might be given that we want to. My husband is fully retired, so given the right opportunity, if we were to do some kind of consulting and some project work, that may be something. But that would, those things aren't necessarily that easy to get given given our potential constraints and stuff like that. So yeah, I think we'd like to do some stuff. I can't say that it'd be all that easy, but
Yeah. Yeah, no, that totally makes sense. Just out of curiosity, what type of consulting work would you guys do?
So it would just be kind of so I'm currently in risk management right now. So for projects that for companies that may just need a couple of months here or there for different things, that's what kind of the things that I would do. So it would be obviously similar to what I am doing now, but again, that would kind of depend available.
Okay, yeah, fair enough. That makes sense. How many years do you have with the university there?
7.
Okay, and then prior to that, what were you doing before? Would you another public employer or somewhere private?
So I was a partner at a public accounting firm for almost 3 years, and then I had done a consulting firm, and I was there for 16 years, starting from a little after business school. And prior to that, I was doing some consulting with another public accounting firm.
Mm-hmm. Okay.
So that helps.
Yeah, no, that's perfect. So you're the bulk of your retirement really isn't gonna come from the current employer. It's more probably Social Security and supplemental retirement accounts, right?
Correct.
Okay, cool. So you got 7 years from there. So your UC pension will pay something, not probably a ton, being that you're going to have 7, 8, 9 years of service when you retire. And then, have you logged into your Social Security account at all online?
Yeah.
Okay, that's another piece of the puzzle here is how much they're going to pay you and at what age. Do you happen to remember what that statement said?
Yeah. Hold on, let me go look. So if I were to retire today, it would be about $2,500 a month.
Okay.
If I were to retire at 70, so that would be 7 years. 30. Oh, so I'm sorry, I should do 65, right? So 24, 25.
Usually shows 67 on the statement, but go ahead.
Okay. So it is about 3,100.
Okay. That's at 67?
Correct.
Yeah. Okay, great. And then what have you set up for your supplemental accounts?
I have maybe 150,000 in there. I've got couple of Roths and IRAs and some retirement fund, probably couple 100,000. So maybe, hang on, all in maybe 500,000 or 600,000.
Okay, and those are the Roth and the IRA are external to you, right?
Correct.
Okay, are those at like Fidelity or Schwab or?
They're mostly at Fidelity and Citibank.
Okay, perfect. And then for those type of investments, that are within those, do you know how those are invested?
I mean, they're probably in a balanced portfolio with probably the target date of 65 for the moment.
Okay, like a target date retirement fund?
Yeah.
Okay.
Yeah.
Perfect. Okay, so those are the three components, and thanks for answering all those questions, by the way. Those are the three components you have there. You have your Social Security, which you've got those figures on how much that's going to pay you. We can do a little homework and download that statement and see what they're going to pay you. It may also be beneficial, depending on how that actually shakes out, to take a refund from that account and put it into, one of your IRAs. It really just depends on what your needs are when you go to retire. If it's more important to have a few $100s cash flow, and it could be more than that. I didn't ask you, what's your monthly gross income approximate?
I never looked at gross. Hold on.
Sure.
Hang on for a second. I never looked at gross. That's hilarious. That's terrible. Give me just a second. So bad. Horrible.
That's all right. I mean, that number doesn't matter so much. It just matters what we get deposited, right?
Yeah, 4,600.
Okay, and it's been roughly the same over the last few years? You haven't gotten any sudden increases or decreases?
Not significant. Yeah, I mean, I work as Stanford. If it's a bonus or a salary increase, it's not significant. It's your standard, probably cost of living 2 or 3% kind of thing.
Okay. Yeah. Perfect. Okay. So yeah, and we can do a little calculation on that. It'd be your years of service, which we could factor in. I don't know. We'll just say 9 years of service right now.
Okay.
And then times 0.02%. That's just, again, it's a rough number. There's a chart that actually delineates what percentage of your final average salary you get based on, your years of service. And then we'll just call it about, $50K a year. So, I mean, the rough estimate, and again, this is rough, but the rough estimate is about $9,000 a year, about $750 a month if you were to retire in a couple of years from the pension. So it's good, good spending money, shopping money there. That account that you mentioned was about $150K. That's your contributory account for them, right?
Correct.
Okay. Gotcha. Okay, perfect. Actually a good thing too, because in your scenario, because Social Security would reduce if you were receiving a state pension. And so because you're not going to receive a state pension, you just have it, like you said, it's effectively an IRA. It's actually a 401A, but it's basically the same thing as an IRA inside your employer plan. So you have those two components. And then the other piece of the puzzle obviously is your husband. You said he's already retired. Can you summarize his situation? We don't have to go into detail, but he's already collecting income. He's good for the income he gets from Social Security and his pension and retirement accounts?
He hasn't started collecting. He hasn't collected because I'm still working, so we thought we'd defer.
Yeah, good call. How old is he?
He is. He'll be 66 in a couple months.
Okay.
So he technically qualifies for Medicare, but he's on my plan at the moment.
Okay, yeah, that makes sense. Okay, cool. So I guess at the beginning you had asked, you weren't really sure, you don't know what you don't know type of thing. It looks like you've just got these couple of components here. Obviously you have your investment accounts, the 401 with Stanford, and then the accounts external to there, and then you'll have your Social Security. One of the things that I see a lot with people that are very near retirement age or just retired is an unbalance in their tax deferred and their tax advantage accounts.
Okay.
And so the reason that's significant is because when you turn 72, the IRS has a rule that involves required minimum distributions. Have you heard of this?
Mm-hmm. A little bit.
Yeah. So in the very basic description of what required minimum distributions are is the IRS allows you to defer taxes throughout your working career, and then you save in those retirement accounts. But when you turn 72, they say, hey, it's time to pay the piper. You can't defer this tax anymore. And then you have to take distributions whether or not you need them. Which is fine unless it creates an unnecessary tax liability with everything else that you guys have going on at that time. And so one of the things that is smart to do is to plan for that ahead of time to see if there's a way you could mitigate any potential unnecessary tax burden at 72 by implementing a tax-efficient strategy ahead of time, one of which could be a Roth conversion. Have you heard of Roth conversions?
Yeah.
Yep. So Roth conversions is one strategy, and then the other strategy depends a little bit more on your specific situation, but there are estate planning strategies that help you mitigate the unnecessary tax burdens as well. So those are the couple of things that might be beneficial for you to look a little bit more into. And if you'd like, I can actually do a tax liability analysis, which will actually show your tax liability starting hypothetically if you retire at 65. We account for Social Security, the total household Social Security, your investment accounts. We make a projection based on how they're invested. So if they're blended target date retirement funds, we might factor in an 8% return. And then we project that out and we see if taxes stay the same, what is your tax liability? If they go down, how does that change things? And then that usually is pretty revealing, and it can help guide you to making any necessary changes with those allocations in the meantime. Does that make sense?
I think so.
It was a very long run-on sentence. I apologize.
Yeah, no. I mean, I think, yes. I mean, it basically is, if I could say it, and I'm sure it's not technically correct, whatever, but it's basically thinking about how my cash flow would work based on the distributions and the IRS rules and all that other stuff should I retire at 65, right? And you're trying to minimize the tax obligation.
Yeah.
Based on how I am then choosing to defer, just take distributions from my various accounts.
Yeah, no, you've got it 100%. What we can do for you is we can run all of those different tax scenarios. We can see, we can make projections on account balances, retirement dates, and we can do, if this happens, then this is what we would do. If that happens, then this is what we would do. And the only thing that I really need to do that, I have your income, you just turned 63, you have your age. The only other thing I really need is those account statements for your retirement accounts, both the one inside of Stanford and then the ones that you have elsewhere at Fidelity. Do you happen to have access to those like digitally or have them laying around the house?
Yeah, I do.
Okay, perfect. Well, what I would suggest is to just send those over to me via the email that I sent you before. We can schedule a follow-up. We need about 48 hours for the team to do the analysis. We have a CPA look at it. And if there's any estate planning considerations, we have the attorney look at it as well. And then we have a screen share where I go over everything with you in detail, sort of like the findings and then the recommendation for those type of accounts.
Okay, and I'm sorry, so it wasn't clear when I first got this notice that that this was a benefit that we could do. I wasn't clear how you were associated with this. Are you a broker or you're not affiliated with, obviously, if you're dealing with clients, right?
Yeah, that's a great question. We get that all the time, and I'm sorry for the confusion. We're a nationwide organization and consists of about 250 advisors that on a volunteer basis work with public employees. We assist them with their retirement. The reason that our organization was established is because we found that people such as yourself don't have holistic resources within the universities and the public employers. And the reason why is because it's a conflict of interest to have a financial professional who is also on payroll with these type of entities. And we provide unbiased, holistic retirement advice. We're fiduciary advisors. And you're probably thinking like, well, why do you volunteer your time? And that doesn't make sense. How do you get paid? We found that when we volunteer our time and we act in a fiduciary capacity, which we are legally and ethically required to do, that out of every few people that we meet with, one or two of them will decide to work with us long term. Just provide free advice, we high five, and you're always able to reach out to us if you have any additional questions. But if we do work together on an ongoing basis, we are a fee-based firm, and we can talk about those implications if it even gets to that point in time. For the purpose of our next meeting, it would really just be an analysis that was like I described. We'll have the team look over, provide the details to me, I'll relay them to you, and then we can go from there.
Okay, yeah, so basically when I give you the universe of my assets and where all of those things are, then you help develop a strategy for reallocating or distribution timing and stuff like that, and then there's a percentage of that portfolio, if you will, that you get paid. Is that right?
Yeah.
Okay. Yeah. So.
And I'll send you. Well, I was going to say I'm going to send you some information about the organization and myself as well. And if you want, I know some people are reluctant to kind of send their statements out into the ether. We don't need any personal information on those. We don't need names or account numbers or addresses. We really just need the holdings and the type of account. That way we know how it's tax classified, how it's invested, so we can do the analysis. Everything else is arbitrary at this point in time.
So if you could send in on the company and things like that, because I have a tax accountant at the moment who also has a financial planning arm that I have not yet used. So I wanted to kind of get a sense for what you did,
Sure.
what you do, compare that to what they do. But that would be helpful.
Yeah, totally. I'm gonna send you, I'll just respond to the email. That's gonna have our website, and then I will, did you want to schedule a follow-up appointment?
Not now, because part of this, obviously, well, maybe not obviously, I wanted to talk with my husband and just, because part of this, I would imagine it's a joint decision and joint assets of sorts, right? So,
Totally.
So I wanted to get his take on this, because as I said, I wasn't really sure what this benefit was, quite honestly, and what to expect. So let me talk with him about it, and I will reach out to you if we want to move forward.
Yeah.
That's okay?
Yeah,
Right.
no, that sounds great. And I'll just remind you that we provide information, and what I always tell people is that more information is rarely a bad thing. So if you already have a good line with your CPA that does investment advisory services as well, then you might want to take that up. But it's always good to get a different viewpoint.
Sure. No, I agree. I agree with that.
Good. Okay, great. Well, you've got my contact info. I'll just set a note to shoot you a text here in a couple of weeks just to follow up, and we can either go on to the next steps or close the case. Does that sound good?
Yeah, that sounds great, Jamie. I appreciate it.
Yeah, thanks a lot.
Okay, talk to you soon. Bye.
Yeah, bye. Okay, so you can see there, it can be delicate. You have to be persistent, but you have to do it in a friendly manner that will allow that person to be honest with you. And you can see she was telling me lots of information. She was telling me about this, she was telling me about that, and then she said, oh, we got this CPA. I guarantee you, and it's hard to not say this, but if we do that, her CPA is like investment advisory services, and I would go head to head with him any day of the week on our investment analysis, on the Morningstar, on that pattern that I do. I would go head to head with that guy any freaking day of the week. In fact, the majority of most other investment advisors. And so you want to sort of live to fight another day. It's like, hey, it's prudent to get a second opinion, to get another viewpoint. Information isn't a bad thing, but she didn't want to schedule the appointment. Now, some of you guys might say, well, you should have scheduled a follow-up appointment. I 1000% could have said, hey, I've got next Thursday. Is 2 o'clock or 4 o'clock better for you? I could have got her to agree, and if she said no, I could have handled that, and I could have got her to schedule the appointment. I don't want shit on my calendar that's reluctant. I don't want shit on my calendar that I'm gonna have to send the statements back to my team, do an analysis, me review the analysis, rehearse the analysis, show up to the first appointment, do the analysis, if they even show up. I want good prospects on my calendar. I want good, committed, interested opportunities. And so I make a judgment call on those to where if it doesn't sound high intent or it's not likely to stick, I won't put it on my calendar because I want something that it is good, an opportunity in that slot that I am able to close, and it isn't just gonna sit there and nod their head and be polite and then get off the call. So she was honest to tell me, hey, my husband is going to be part of that decision. Obviously, I step it along. I can't ask for all her statements and all her husband's statements and both of them to show up to the second appointment. There's some finesse involved. There's some salesmanship, but at the end of the day, I know that I can help this woman. She's got some money in Roth. She's got, $500,000. Her husband probably has the same, if not more. Maybe it's a $2 million household. It could be a really good case if I can just get through to them. And that's what I'll do here. I'll call her back or send her a text in a couple of weeks. Hey, blah, blah, blah. Did you talk to your husband? Or here's this piece of information regarding required minimum distributions, which is a better way to reach out. So just keep that in mind. Hey, it's pipeline. It's more money in the pipeline. It's more at bats. We'll put them in the nurture sequence. We'll follow up with them, and we will keep rocking. Live to fight another day.